So in one of the Barefoot Investors' recent email newsletter, there was one that I just had to click on. It was titled, Why I Love Higher Rates, and I thought others might be intrigued just as I was. And he starts off with the disclaimer, a word of warning. What I'm about to say is going to trigger a lot of people. I'm actually cheering on higher interest rates. That puts me at odds with practically every other financial commentator, yet I couldn't care less. He says there's a lot to like about higher interest rates. The first reason that he loves higher interest rates is that it gives people an incentive to save money. This is because the interest rates for savings accounts has increased. The media tend to only talk about the doom and gloom of mortgage interest rates rising. And here is an announcement from the CBA as an example that gives a snapshot of these changes. Their net bank saver has increased from 0.25% to 1.1% with an introductory offer as well. Their gold saver has increased from 0.3% to 2.4%. And their youth saver has increased from 0.3% to 2.6%. There are better deals out there, of course, and we will chat about those later in the video. The second reason is that it discourages speculation. The Barefoot Investor says it discourages people from speculating on dumb things. When interest rates were low, people who would normally have their money in savings account may have started to look for higher returns in other asset classes that they may have a limited understanding of. The cash rate was so low, and at 0.25%, it meant that holding cash meant that your money may not have been keeping up with inflation. Hence why people started looking for better deals elsewhere. And of course, I must mention that the information in this video is for entertainment and general information only. You can read my full disclaimer in the description box below. The third reason, according to the Barefoot Investor, is that it brings down house prices. He says that higher interest rates bring down house prices and give first home buyers a fighting chance to get in. I have noticed in Brisbane that things have slowed down a little, and the median house price in my suburb has definitely dropped. This is my suburb in this graph, and it shows that prices have stagnated with a slight increase recently, which does buy first homeowners time rather than feeling like they have to rush in because house prices are running away from them. I found this infographic and I will leave a link in the video description. And it shows that some major cities are seeing a decline, but not all of them. But nationally, it looks like there is an overall drop. And the last reason as to why the Barefoot Investor likes higher interest rates are that they help risk-averse pensioners. He says that they help pensioners earn a few crumbs without risking all of their money in the share market. Many pensioners prefer to hold cash, as during their lifetime the returns on cash were much better than what they are now. So for many older retirees, it wasn't that long ago that their cash was earning a decent return. And it only really started to drop in the last 10 years. And of course, if you are enjoying this video so far, don't forget to give it a thumbs up because it really does help to support my channel. He then talks about how you can get a higher rate on your savings. The Barefoot Investor says that over the past few months, the banks have really been stepping up their game. You can now earn as much as 4.45% for locking your money away in a 2-year term deposit with mainstream finance outfits, known as Authorized Deposit Institutions or ADIs. ADIs come with a government guarantee which provides protection to depositors of up to $250,000 in the event of the ADI failing. I think he mentioned the importance of going with an ADI bank as there's lots of products out there, looks like a savings account, but actually invest in fixed income bonds. And there are even some products out there that are investing in crypto without making it clear. So I thought I'd check out some of the term deposit rates, and they do seem to be between that 4 and 5% depending on the term. He also goes on to say that I wouldn't be rushing in to lock my money away at the moment. That's because our old friends, the humble online savings account, are now much less sucky. Some online savers are paying as much as 3.6% without having to lock your money away, which gives you the ability to switch if there's a higher deal somewhere else. Some online savings are paying just over 4%, but something to be mindful of is the conditions required to get that rate. An example is ING. Customers must deposit $1,000 from an external source each month, make 5 card purchases, and grow the balance. That's a lot of hoops to jump through. And in some cases, some people prefer to go with a slightly lower rate that doesn't require them to jump through hoops, like this Macquarie one, for example. So he finishes with saying, "So unlike the rest of the media, I'm not going to pander to the postcode panics with every 0.25% rate increase. However, as a financial counselor, I do understand that higher rates are really hurting those who have borrowed too much." He then suggests speaking to a free financial counselor like himself if needed. Here are my thoughts that you didn't ask for, but I'll give them to you anyway. I think his points are valid, but I'm going to sit on the fence here and say that surely there needs to be some sort of happy medium. I think what has hurt the most is just the speed and aggressiveness of the increases. It hasn't given people with mortgages time to make changes and adjust if they need to. What do you think? Let me know in the comments below. And that's it for today. Thanks for listening. Don't forget you can also find me on Instagram and Facebook.